In 1986, a quiet, almost absurd financial experiment began in a small town store. Sell every single item in the building for exactly $1, and somehow try to build a profitable business. Wall Street analysts looked at the numbers and laughed. They said it was mathematically impossible. They insisted that inflation, rising transport costs, and shifting real estate prices would crush the company within months. Yet today, Dollar Tree operates over 16,000 locations, pulls in tens of billions of dollars every single year, and stands as one of the most profitable retail monsters in modern history. So, how did a company built on loose pocket change outsmart massive retail competitors? The answer isn't what you think. Dollar Tree is not actually in the business of selling cheap plastic toys. They are running one of the most ruthless, brilliant, and deeply psychological money-making machines ever engineered. When you walk into a traditional grocery store, you expect to pay for brand names, convenience, and choices. But the second you step inside a Dollar Tree, your entire brain shifts into a completely different economic mode. You think you are saving money. In reality, you have just walked into a carefully designed financial trap where every single shelf, package size, and price tag has been built to pull maximum profits straight out of your pocket. To uncover how this economic engine actually works, you have to throw out everything you think you know about traditional business. Most retailers buy a product, add their profit margin, and then set the final tag. If supply costs go up, they raise the price. But for over 35 years, Dollar Tree couldn't do that. Their price was locked at one single dollar. That extreme limitation forced them to invent a hidden financial framework. It starts with the concept of absolute, extreme volume. Dollar Tree doesn't buy goods like an ordinary store. They buy like an empire. When a massive manufacturer overproduces inventory, or when a major brand changes its box design by half an inch, traditional stores refuse to take the stock. Dollar Tree steps in with instant cash, buying up millions of leftover items for pennies on the dollar, forcing desperate suppliers to take massive losses just to clear out warehouse space. But liquidating excess inventory is only a tiny fraction of the mystery. The real secret lies in something far more calculated: custom unit economics. Have you ever picked up a box of cereal or a bottle of dish soap at Dollar Tree and noticed it looks identical to the one at a major supermarket, but feels just a little bit lighter? That isn't an accident. It's shrinkflation engineered at the highest corporate level. Dollar Tree goes directly to major global brands like Crest, Colgate, and Kraft with a simple deal. Manufacture a custom, smaller package size specifically for our store shelves. Instead of selling a 10-ounce bottle of soap for $3 like Walmart, Dollar Tree sells a 3-ounce bottle for $1. To the average customer, spending a single dollar feels like an incredible bargain. But mathematically, you are paying significantly more per ounce than if you had bought the larger bottle down the street. That illusion of cheapness generates a shockingly high profit margin. Yet, custom packaging is only the beginning. There is a far darker, more strategic reason why Dollar Tree systematically destroys local competition. And it stays hidden deep inside the commercial real estate market. While giant retailers like Target spend tens of millions of dollars building massive superstores in prime commercial districts, Dollar Tree takes the exact opposite path. They hunt for cheap, abandoned retail spaces in rural small towns and low-income urban neighborhoods. Locations that traditional corporations completely ignore because local income levels are considered too low. Dollar Tree moves into these retail deserts with virtually zero competition. They spend almost nothing on interior design. The floors are bare concrete. The lighting is cheap industrial fluorescent. And the aisles are packed tightly with minimal staff. A typical store operates with just 2 or 3 workers on shift at any given moment. By stripping operational overhead down to absolute zero, every single square foot of the store transforms into a high-yielding cash machine. This real estate strategy creates an unbreakable competitive moat. Once a discount store opens in an underserved area, it frequently starves out local grocery stores that simply cannot match the perception of ultra-low prices. Once those local businesses disappear, Dollar Tree becomes the sole provider of daily household goods for an entire community. Now, here is where the story takes an insane financial turn. If selling cheap items in low-cost stores brings in millions, how did Dollar Tree transform into a multi-billion-dollar titan? The answer lies in how they manage their cash flow behind closed doors. Unlike high-end retailers who hold products on their shelves for months, Dollar Tree turns over its inventory at lightning speed. Products arrive on trucks, get unpacked onto shelves, and are purchased by cash-paying customers within days, long before Dollar Tree ever has to pay its original suppliers. This creates a permanent, rolling river of cash float. They hold hundreds of millions of dollars in liquid funds that they can immediately reinvest, earn interest on, or use to fund rapid expansion, all financed on the credit of their suppliers. But by 2021, a massive crisis threatened to tear the entire company apart. Global inflation surged. Shipping container costs exploded by hundreds of %. Raw material prices skyrocketed. Suddenly, buying products for 50 cents to sell for $1 was no longer mathematically possible. Financial news outlets claimed the dollar store model was officially dead, and investors began to panic. And then, Dollar Tree executed a move that stunned the entire corporate world. They quietly abandoned their iconic $1 price point, raising their baseline price to $1.25. On the surface, a 25-cent increase sounds tiny. It's just a single quarter, but mathematically, it was one of the single greatest profit expansions in modern retail history. Look at the raw numbers. Increasing a price from $1 to $1.25 represents an immediate 25% jump in top-line revenue, while fixed operational costs like rent, cashier wages, and electricity stayed virtually unchanged. Overnight, items that were operating on razor-thin margins turned into massive cash drivers. And customer traffic barely dropped, because even at $1.25, the psychological perception of a deal remained completely intact. Yet, that 25-cent price hike was actually a Trojan horse for a much bigger strategy. Enter the Dollar Tree Plus initiative. By breaking the sacred $1 promise, the company unlocked the power to introduce multi-tier pricing. Suddenly, store shelves began featuring items priced at $3, $5, and even $7. The company was no longer restricted to selling tiny snacks and cheap trinkets. They could now stock frozen foods, household electronics, clothes, and seasonal home decor, products carrying vastly higher profit margins. This single strategic shift completely transformed their customer profile. Middle-income shoppers, hit hard by broader inflation, began walking into Dollar Tree looking for relief on everyday essentials. And once those shoppers stepped inside, the psychological mechanics of the store layout took complete control. If you have ever walked into a store intending to buy a single roll of tape and walked out with a basket full of impulse purchases, you have experienced this exact trap firsthand. Dollar Tree doesn't organize its aisles logically. They intentionally mix high-value brand names right next to cheap impulse goods. A customer walks in to grab cheap paper towels, spots seasonal decorations, cheap snacks, and party supplies, and suddenly drops $30 at the register. The true genius of the model isn't getting you to spend $1. It's getting you to buy 30 individual $1 items without ever stopping to calculate the total bill. So, what does the future hold for this discount giant? As automation and artificial intelligence reshape the retail industry, Dollar Tree is quietly modernizing its back-end infrastructure. They are rolling out automated distribution centers and predictive inventory software that tracks hyperlocal demographic trends, ensuring that every individual location gets the exact products its specific neighborhood demands. Critics argue that discount chains harm local communities by driving out fresh produce markets and keeping retail wages low. City councils across the country have even tried passing strict zoning laws to block new construction. Yet, despite political pushback and economic uncertainty, consumer demand for discount retail continues to hit record highs. Because when the economy slows down, Dollar Tree doesn't suffer. It thrives. The ultimate takeaway isn't that Dollar Tree figured out how to sell cheap items. The real revelation is that they built an unbeatable financial engine by mastering human psychology, hyper-efficient real estate, and aggressive supply chain control. They proved that in the world of global business,